My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today our special guest is Fred Moskowitz, zooming in from beautiful Philadelphia. And Fred is a very accomplished entrepreneur and an author. And for the purpose of our conversation here today, we're going to focus a lot on note investing, because when it comes to real estate, that's what Fred is known for best, is using notes as an investment vehicle. So Fred, welcome to the show. Great to have you.
Thank you, Dave. It's great to be here.
So, hey, for folks who don't know a note from a knot, what is a note exactly when it comes to real estate and real estate investing?
Yeah, when it comes to real estate investing, note investing is all about investing in the debt side of all of these transactions, right? In real estate, everyone knows about the different asset classes. You got single family houses or commercial property, multifamily property, and even vacation properties, right? Those short-term rentals, which is really popular now. So let's talk about investing in the paper, where instead of owning the property, we can own the notes and the mortgages which are associated with all of those properties. And you know something, this is a really interesting part of the real estate business. And one thing that I found is that a lot of real estate investors, they don't pay any attention to it. Most investors, when they think of a note and a mortgage, they think about it from the perspective of being the borrower and not as being a lender.
Yeah,
But
they're
with
only thinking about going to the bank, getting financing for the property. If they're doing flips, they're thinking about going to a hard money lender, what have you, getting somebody to put up the money so they can buy the property, right? And then the lender has the mortgage, has the note on it. And you're talking about turning things around and becoming the lender.
Yeah, you can become the lender. You can actually buy mortgages on the secondary market, because the way mortgage financing works is that banks and lenders, they create mortgages, they originate them, but very often it's with the intent of selling it within 3 to 6 months after closing the loan. And so there's a huge market where loans are bought and sold every day, and they get bought up by Wall Street funds, institutional funds, and put into mortgage-backed securities. And over time, those instruments get broken down, and then all those loans, they get sold again. They have value, they have a loan balance active against them. And so for us as investors, we're able to go and buy these loans and hold them in a portfolio. And so this is really a cash flow play, which is a nice diversification from owning real estate.
Yeah. So if people are listening to this and saying, well, hey, that sounds kind of interesting, because, buying a property, doing all the work to renovate it, then putting tenants in it and dealing with all of that, it's kind of a pain in the butt. Maybe being the bank might be better. But Fred, my mortgage is $300,000, $400,000, whatever it is. I don't have $300,000 or $400,000 to be the bank for somebody else. So this can't work for me, I guess. What would you say?
That's a great point. Note investing is a capital intensive activity. So you need cash to buy the loans, right?
How much cash would you need?
It depends on the size of the loan. There are loan sizes as small as $5,000 or less, all the way up to $1 million plus, right? On those jumbo loans from the properties in more affluent areas, they're called jumbo loans, and everything in between. So there's something out there for every investor.
So if somebody's getting into thinking about, okay, well, I can come up with 10,000, 20,000, 30,000. Chances are they're probably not getting a first position mortgage on a property? What kind of paper would they typically be getting under that situation?
Yeah,
What kind of properties?
all kinds of property values, but yeah, that could be something like a mortgage that was a home equity loan, so it's in second position,
Mm.
and it could be on a very desirable property that's well maintained in a solid real estate market, and that's a good loan to buy, right? And so every loan you evaluate it and perform due diligence and according to your risk tolerance and what you're comfortable with, you can look at all these different parameters: the borrower, the collateral, what's the real estate market where this property is located, and decide if it's a note that it would be a good investment for you.
Yeah. So I know there's tons of different variables here, but give us an idea, Fred, of people that are experienced like yourself with notes.
Mhm.
What kind of return are you looking for to make a note attractive?
Yeah, this is a great question. So again, it comes down to how much risk are you comfortable with? Every investor has a different risk tolerance. And so just to give you an idea, if you were looking at a super safe note with very quality collateral and a clean payment history, good strong borrower profile, right? That might be a lower rate of return. Of course, if you want less risk and more safety, you're going to have a lower rate of return. That
Like
might be
what?
around 5 or 6%, something like that. Okay. And
So
then
how
as
how
we,
would that compare with just putting your money in a certificate of deposit or something like that?
well, you're getting a higher rate of return than a
Mhm.
certificate of deposit. You're investing in something that's backed by collateral. There's a hard
Okay.
asset backing your investment, and so there's a lot of safety there. Now, let's move up the ladder. Right, we can look at loans that have less than perfect payment history or a lower credit score for the borrower, or maybe they're located in a less desirable neighborhood or area. What if the loan has missed payments here and there, but
Yeah.
the borrower seems to always get caught up
Gets caught
again
up.
in
They're
the
just a
end?
little slow sometimes. Yeah.
Yeah, or maybe they have seasonal work where there's a
Uh,
couple of months out of the year where there's not much income coming in, and then they get caught up again, and that's a recurring pattern. And so that those type of scenarios make it where you can't call it a top class type of loan
mhm.
classification. However, you may be okay with that, and now you can earn a higher rate of return. Now we're looking at 7, 8%, 9%. What if that loan is made to a real estate investor that has a lot of properties, right? The bank considers that higher risk, but maybe you're an experienced real estate investor, you know that space well, and you're okay with that, and you say, hey, I'm willing to take a higher rate of return for this added risk.
Got it.
Right? What if you invest in hard money loans? Right? A lot of real estate investors know about using hard money loans. Well, what do those loans look like? They're 12 or 14% for a 6 month or 12 month term, right?
Mhm.
And you're lending on a property that's getting renovated and rehab. There's not someone living there. So you have some of these different scenarios.
So
And
are you doing those kind of hard money loan notes, or
well,
is that
they're
what you're
they're
saying?
out there. What I'm saying is all of these types of
I see.
debt are out there available to buy on
So
the
so
secondary market.
the more traditional notes that you and the people that you teach about this are doing, what do they kind of look like? What kind of are they first? Are they seconds? Are they
Yeah,
more of the steady Eddie ones or a little higher risk? What are you guys looking for?
yeah, generally lower risk. I always like the idea of start out with lower risk, less complications, less problems. Get comfortable with that. And then over time, as you get more experience and more expertise, you can start to venture into some of the higher risk type loans and earn a higher rate of return. But this goes for any type of investing, even if you are doing property investing, it's the same thing, right? You start out with something that's straightforward and easy to get your experience, get comfortable, and then over time you can take on more complex and properties that have more upside in them. And those are going to require more expertise, more wherewithal, usually more money as well, more of a capital investment. And so it's the same idea. But I always recommend when you're starting out, stay simple and get comfortable, get your systems and processes in place,
Yeah.
get your relationships in place that you need to operate well in this business. And then over time, you can branch out.
So what would you recommend, just kind of rule of thumb, Fred, for, if somebody wants to get into this as more than just like a little side type thing,
Mhm.
if they want to create some, significant either part-time or full-time income from this note investing, what kind of capital should they have access to?
Yeah, um, there's a lot of different strategies here. But what I would say the most important thing to keep in mind is to decide whether you want to be an active node investor or a passive node investor. And it comes down to how much time do you have available that you want to dedicate to this. If you say you have a lot of time, then you can be an active node investor. Buy notes, build up a portfolio, get them managed, get them stabilized. And if you say, hey, I don't have a lot of time, I'm busy, I'm operating another business, or maybe you're working in corporate as a professional and doing well with that, you can invest passively in a note fund that's professionally managed. It looks a lot like a real estate syndication where you invest your capital, you're paid out a monthly rate of return, and you find one that is in line with the risk tolerance you have as well. Some pay a lower return, some pay a higher return. And so it's a matter of getting exposure and building relationships in the marketplace to see what options are out there. But I always say for someone starting out, you want to answer that question. Do you want to be active or passive, and start from there and see how it goes? And you can always change up your strategy over time.
Yeah, there's a lot involved with this. I think probably the biggest thing, like with anything, is to get the education about what's
Yeah.
involved, right? And then you can decide a little bit better. Do I want to be more active or more passive, or do I even want to do this at all? That it's important to understand the concept. So I think, Fred, I think you've got some educational resources for people if they want to find out more.
Yeah.
Tell us a little bit about that.
Yeah, absolutely. Well, I have my book on node investing, which is available on Amazon. It's called The Little Green Book of Node Investing. And in there, we talk about an overview of the node industry as well as how to perform due diligence. We have some case studies in there, how to analyze notes, where to buy notes, where to look for them to buy them, and also how to make the determination whether to be active or passive. And my favorite topic in there that we have two chapters talking about how to invest in notes using capital in your retirement accounts, which is a great option for some people. So that's one way. That's the book that's available on Amazon. And also, I have a free gift that I'd like to offer all you listeners out there. If you
Sure.
go to my website at giftfromfred.com, you can download a special report I have on node investing, talking about the basics a little more in depth than what we covered here today. And I'm happy to send that out to anyone that would like to request that.
What was that website again?
Giftfromfred.com.
I like that. It's short and simple.
And
Awesome, Fred.
easy
Well,
to
hey,
spell.
thanks. Yeah, thanks so much for being on the show. I appreciate your time.
Yeah, thank you so much for having me. Appreciate it.
All right, everybody, take care. We'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.